All right, good afternoon. We're talking about what the changes are in the current market environment. This is just a quick update video on what's going on. We are going to be making some changes to the investments. We're seeing just really an interesting market. We're kind of can go either way. So I'm going to give you both the bull and the bear case and let you know what we're doing with the investments to kind of protect us on both sides. Making sure that we're diversified no matter what happens with the market. So number one, the stock market's going to keep going up. We're at all these highs, everything's doing great. The bull case is, look, there's a lot of cash on the sidelines. There's more cash on the sidelines than there has been in a long time. There's a lot of people waiting to invest. There's a lot of money that can be put to work in the stock market. So that money is going to get allocated and the stock prices are going to go up. Furthermore, the corporations that are reporting earnings, just recent earnings estimates, they blew out the numbers. Companies are making way more profit than what they had projected. So the current PE ratios and current ratios that show the stock market is really overvalued are not accurate. There's going to be a lot more income and profits from these companies, so the valuations are good. So that's the bull case. That says that the market's going to keep going up and everything's great. The bear case is, well, let's look at the numbers. I mean, we're trading at some of the highest PE, PEG ratios. The CAPE index says that the market's at a top. We're way overvalued. Some of the more popular indicators, what they call the Buffett indicator. This is where you compare the market cap of like the Wilshire 5000 against the gross domestic product, the GDP of this country, trading at all-time highs. I mean, higher than it was in 99, higher than it was in 2007. So, you know, who's right? Here's my thoughts on the whole thing. I think it's all dependent on interest rates. As long as interest rates stay very low, the market could sustain these valuations and these companies continue to turn good profits. They continue to outperform. They get more profit than what they're projecting. The market can keep going up as long as interest rates stay low. Now, the government has an incentive to keep interest rates low because the government's running big debts and has big deficits, and they don't want to pay more interest on the money that they are printing and spending and the whole bit. So maybe the market will continue to go up as long as we have low rates. What could stop this whole thing and what could cause interest rates to go up? And it's very simple: inflation. Prices going up. What can happen is you start to have this cycle that starts where prices go up for this, which causes these prices to go up, which causes these prices to go up, and it kind of goes throughout the whole supply chain. And I believe, personally, my own personal opinion is that inflation is going to be a lot worse than people realize. I think we're starting to see it. Obviously, the big one that everyone's talking about is plywood and 2x4s, the price of wood going up. But it's not just wood. I mean, we're seeing it in copper prices. We're seeing it across the board in the supply chain. One of the recent videos I watched of the Berkshire Hathaway meeting where they asked Warren Buffett flat out what he was thinking about inflation. And he's a guy that tries to moderate himself. Everyone knows they're watching it, every word he makes. And you start to see him say, oh, yeah, there's a frenzy. And then he kind of tries to back off what he's saying because he wanted to moderate, kind of what he was saying. But at the end of the day, inflation's here, and it's big time. And so what's going to happen is prices are going to start going up, and we're going to see it at the grocery store. We're going to see it at Home Depot. We're going to see it across the board. There's going to be shortages in the supply chain. You're going to see where you got to wait a long time. You put an order for something, and it takes months and months and months to arrive. And it's just because of what's going on with inflation. And eventually prices are going to start moving up. And when prices really start to move up, it's going to create a cyclical effect where the prices keep moving up even faster, which causes prices to go up even faster, which causes prices to go up even faster. Well, the only way that they can get this under control is to raise interest rates. And that will be when everything changes. When rates go up, asset prices are going to drop, specifically real estate prices, stock prices. It depends on the stock. Obviously, the companies that have good dividend yields, good value companies can raise the price of their products or make the container smaller. Just recently, Costco reduced the paper towel rolls by 20 sheets and be like, oh, it's only 20 sheet difference. Well, that represents a 14% increase in prices. Even though they're charging the same price for the paper towels, you get 14% less paper towel. That's a 14% increase in the price. And so this is what you're going to start seeing across the board. So we got to be prepared for this. And when this happens, and specifically when you start to see the interest rates go up, and at the same time the interest rates are going up, the price of gold is not going down, which is the typical initial reaction to interest rates going up, that's when you're going to see things really take off. And you're going to see the precious metals market take off. You're going to see a lot of the natural resources and things like that. So in light of that, we obviously are heavily focused on value stocks right now. We want to be in that sector. We think they're going to continue to outperform. Obviously, they've done substantially better this year, so we've been in a really good position with all of our client accounts so far. We are also going to start to do more hedging, protecting against a big downturn in the market, which could happen if we see a spike in interest rates. You'll see a big potential temporary drop in market prices. But we're also going to be looking at some other inflation protections. So we've got a few different investments that we're going to be cycling our clients into. One of those is a natural resources ETF. This is one where we're investing in lumber and agriculture and natural resources. And so we want to jump in on that. And I do think you're going to see prices, not just of wood. You're going to see it in copper. You're going to see it in steel. You're going to see it across the board. We're starting to see shipping prices just over the top. You can't even get realistic shipping prices on products out of China, Brazil, things like that. So it's all starting. We're preparing for it. Make sure you're preparing for it in your own personal life and your own personal purchases. Just be aware there will be shortages in the supply chain. It will take longer to get stuff that you order, and the prices are going to go up. And I believe they're going to go up a lot more than people realize. And what ultimately will happen is the Federal Reserve will be behind the curve. And once they realize it'll be kind of a little bit out of control, and they're going to have to really raise rates in order to get it under control. And it really, we could, people say, oh, how can that happen again? The 1970s, Jimmy Carter, 20% interest rates. It can happen again. And especially if the Federal Reserve drops the ball and lets the inflation get too overheated before they take any action. And, I don't know if they can take a whole lot of action. We're running major deficits. I don't know how they can possibly raise rates. If they raise rates, they're going to have to print even more money to cover the shortfall. So it's going to be, the only solution really to the whole problem is for the government to cut spending. And I don't think that's going to happen with the current politicians in office. So we'll see how that plays out. But anyhow, quick update on what's going on with the market. I hope that helps everyone. And feel free to reach out if you have any questions. And you will see some adjustments in the investment accounts where we focus more on natural resources and just take a little more precautionary approach to the market, just because current valuations are a bit high when you look at market cap to GDP, P ratios, PEG, so on and so forth. So hope everyone's doing well, and we'll see you next time.